Hi everyone, welcome back. It's Chris Carlson with Bowman Hanson, your online investment bank. In today's video, I will discuss how private equity values privately held businesses. We'll give you examples of multiples paid by different types and sizes of businesses. Before we get into the video, please like and subscribe. We have lots more great content coming out. Let's get into it. So, quick review. First of all, private equity. Very simply, private equity pools privately held capital, whether it's held by high net individuals, pension funds, or institutions, to acquire privately held companies. Now let's move into the nitty gritty, how they value your company. According to this 2023 Pepperdine report, you can see that the most common valuation technique that private equity uses to acquire companies is the discounted cash flow method, followed by the capitalization of earnings method. When you get down to how they value companies using a multiplier method, that is a multiple of EBITDA, the most common is the recast multiple of EBITDA, followed by just a standard EBITDA. And EBITDA, remember, is earnings before interest, tax, depreciation, and amortization. In this video, we're going to focus on the multiple of earnings method. The discounted cash flow analysis is very simple. They estimate future earnings and discount those to the present day value of the money. That's a very complicated type of valuation and is typically more often used on either high-tech businesses or hyper-growth companies. In today's video, we're working with really our audience is middle market or lower middle market, and these are deals that sell for between $5 million and $100 million and are companies that grow at 5 to 20% a year. And these are mostly manufacturing, service, and distribution companies. As we discussed, private equity firms use many methods, but the most common multiplier method is the multiple of EBITDA. And in this table, you can see the different, and these are medians, once again the average, that private equity reported to the Pepperdine report of what they pay for different types, that's sizes of EBITDA, and different types of companies. When we look at those numbers, we think they're a little low. Private equities, they're going to want to brag a little bit about how inexpensively they bought the companies. Now contrast that with this graph that we're going to show you. This is the graph that shows what investment banks reported for the same thing. And you'll notice there's a difference between the two. Some of that is down to bankers wanting to brag about how much they sold the businesses for. And also that investment banks also sell many businesses. Around half do not go to private equity. They'll either go to synergistics or other types of buyers that are non-financial. That should account for most of the differences between these, but you can see there's some substantial differences in the reported EBITDA valuations. So once again, this data is all privately held. There's no public reporting of this data for the most part, so a lot of it is up to interpretation. And once again, a reminder, these are just median numbers. When you're running an investment banking process, the idea of running the process is to beat these numbers. Many people are curious, what size company does private equity typically buy? This chart will show you. You can see that around 50% of the deals that private equity completes are in the kind of $0 to $5 million in EBITDA. That's on a transaction number. If you looked at the number of deals, that's how it looks. But if you look at the dollars going in, it's much skewed to larger deals. So there's many small deals are done, and there's some gigantic big deals that are done. So the numbers are a little skewed if you look at how they're reported here. Now we've talked a little bit about how they do it, the valuation techniques, but before any money is transacted, a private equity firm is going to do a large amount of due diligence. Now before any deal gets completed, any valuation really is just a completed deal, remember that, is that there's going to be a tremendous amount of due diligence. So the private equity firm is going to spend $100,000 or $200,000 checking under the hood, making sure that there's nothing that was not disclosed to them during the bid process. Once again, you want to get ahead of it. If there is any bad information, if you have something that's negative, you want to get ahead of it. You have a lot of leverage with the firm before the letter of intent sign. If they find out something afterwards, you don't have as much leverage. So you want to get ahead of it. The next graph is going to show you the leverage that's in a typical private equity deal. It's very important. The graph that we're showing you right there is total leverage, but really leverage gets broken down between the senior bank financing leverage, that's notes they get from the bank, loans, the debt that's provided by mezzanine, that's typically more expensive for the private equity firm, and the debt that's possibly provided by you, the seller. So all the leverage here is wrapped up into one number. It's just good to look at. So if you look at your median valuation number, let's just say, for example, that your typical firm in your industry sells for 5 times EBITDA. You can go to this chart and say, well, what's the average amount of debt or leverage put onto my deal? Well, if it's 3 times, you can figure out by doing the math that if you sell for 5 times, they put 3 times leverage on it, they're coming up with roughly about 2 times the EBITDA in a down payment or equity going into the deal. It's very important to know that, and also to understand what their terms are that they're offering you. And many times we find that buyers will come in, private equity firms or other types, and they'll ask the seller, what do you want for the company? Maybe you'll give them a number. But what you should really respond to that question with is another question yourself. Ask the buyer, what are the terms you're offering? How much money do you already have available to acquire my company? How much money do you need to go borrow to acquire my company? And how much money are you going to ask to borrow from me? Those are the questions that need to be asked, because the discussion of multiples is meaningless if you don't have a discussion about the terms of the deal and also a discussion about the equity that the company already has that wants to acquire you has. Very, very important. If you're talking to a business and they have hundreds of millions of dollars and you can verify it on the, maybe it's public information, maybe they're a publicly held company, that's much different than talking to someone who possibly can't verify they have any money. So the money that the buyer has, the amount of debt they want to put on your business, all really are tied into this valuation discussion. In conclusion, we've given you a glimpse of what the multiples that private equity typically pays that's reported by private equity. We gave you the multiples that are reported by investment banks. We discussed the amount of leverage that's typical for your industry and size. This will give you an idea of how this is all put together, the geography that you're in, what you do and how you do it. So every business valuation is highly unique, but this will give you a nice overview of what is typically done, and you can really not expect that it's going to be orders of magnitude different for your business. So it's a good just gut check whether you're thinking about being a buyer or a seller. Once again, thanks for your time. We enjoy doing this. We've got lots more videos coming out on discussing how to recast financials, how to buy a competitor, how to sell to a competitor. If you got any other ideas for videos you'd like us to have, please put it in the comments. If you enjoyed what we did today, please give us a thumbs up and like and subscribe. Thanks so much.